I think for this first session, it's good to review the fundamentals, okay, of options. So even things that you're not very familiar with, the delta, gamma, theta, etc. We'll look also into IV, what it means and how it plays around earnings. This is a good, I think, first fundamental level, which is really more about options in general, and earnings are sort of a good application of this knowledge, because earnings periods are basically points in time where a lot of factors play together, right? So you actually see the effect of the theta decay, the stock price, the IV change, etc. So it's like a good exercise, good application where all of it come together. And then next session we can actually start to look, okay, what did it mean? What does it mean for earnings? What is the strategy? We'll start with a simple example, and the one after that we can do a more thorough deep dive, actual like real life example. Sounds good?
Sure. Yes.
Okay, so because again, options are really this is not like a general any other hobby, when you can collect stamps or something. This actually costs money, and it involves money. So you need to know what you're getting into. Okay, in a nutshell, the earnings watcher, and so the idea, the platform, and the strategies. This is not something we created, or is not proprietary, right? Just so you know, these volatility strategies that we talk about, long volatility, short volatility, etc. It's really very famous in the literature. Actually, this is what a lot of people do. Is that earnings watcher would be a place where you can do all this research for earnings trades, right? To get that edge, and so that edge is, just to start off, is not like what you most see, on social media, etc. The fun gamble way on earnings of picking calls or puts, right? It actually involves the volatility, which is, as I said, a step further. Okay, I think the best way to go into this. Okay, so I'm guessing you're familiar with the basics with options. Okay, let's review the basics of the basics. There are two types of options: calls and puts, right? Options are really instruments, basically, that depend on the stock. They offer more leverage. Okay, let's get back to the original definition. There's two, as I said, the call and the put. So a call is the right to purchase the option, the stock. The put is sort of the symmetrical opposite. It's the right to sell. Okay, so you can think of the calls as sort of like a non-commitment, right? The idea is that you can exercise your right to take it, but not necessarily. It's up to you. And it's sort of, you can see it as before, if you want to take a long position on a stock, for example, right? It would be equivalent of that would be going long calls when you're bullish, basically. The put side is sort of like an insurance, if you think about it, where you have the insurance to basically be able to get rid of your stock at a certain price. Okay. There are two main parameters that play in options, in how, in the definition of an option: the strike and the expiration. I'm sure you're familiar with. Okay, now once we've said this, the idea of, when options emerged back, 30 years, 40 years ago, they were not meant as tools of speculations like we do now for trading, etc. Though they were really concrete use cases where, in a nutshell, people who buy calls or calls as an instrument are meant for people who sort of do not want to commit in advance now to a certain cost and not be exposed to future fluctuations. So think, for example, an airplane carrier who buys fuel for its airplanes. The company needs to know what they will be how much they will be spending on the fuel, so they can't be waiting on every day the price of the market and buying it as it goes. It's more reasonable to agree on a certain price for the upcoming year, and then you basically accept to pay an extra premium. That's really the idea, is that you pay extra for these contracts, for these calls, but at least now you know what your cost will be. Meaning that, you know, you for the fuel, let's say, today it's costing, let's say, $100. You buy a call with a strike of $100 on that for next year, meaning that even if it goes to 200, 300, you will be safe. Okay, you can still buy it for 100. It's really important to understand the you know, the origin story, if you like. The put side is really symmetrical, where people who own stock would like an insurance of being able to sell them at a certain price, and so they basically buy this insurance, again, extra premium. Makes sense so far?
Mm-hmm.
Okay, so now the big question, which brings us to what we do, is how can we price a certain option? Okay, if I give you, you know, an example of a certain stock or a commodity, fuel or whatever, if I put a certain strike that's above or below and a certain expiration, how can we find a reasonable price for that option? Why should it be $1, $2? Let me just quickly, we can just look at a classic option chain, you know, for any stock. So let me share this from Yahoo Finance. So you see, okay, for these are calls for Apple. There is the last price. So this is the last exchanged, the last actual price in the market. The question arises of, let me put back the column so you see. Okay, so you have the last price, you have the bid and the ask. So we'll get to that. But really, the idea, the question is, where do these come from? Why is it that this at the money call, you know, this 10 strike is costing this much, 178? Why not 250, you know, or 30? Oh, my idea. This comes to this was answered by a model and an approach to option pricing. Maybe you've heard the name before. It's called the Black-Scholes-Merton model. Okay, so these are people that got the Nobel Prize for it, basically. Well, let's not go too much into the details, but really it's a mathematical model that basically studies the numbers, or the way a stock or a commodity or whatever whatever it is the option is about, and really does a specific, very simple hypothesis, Thomas, where the hypothesis is that, you know, what happened in the past should keep happening, and the big assumption is that things are shaped like a bell curve, basically, like a Gaussian, that I'm sure you're familiar with. Where meaning that if something is at $100, okay, and that in the past it usually is between 90 and 110, for example, out of my head. Well, the model will always assume that that's the sort of expected behavior, okay? That going forward, the prices should stay around the current value, and that bell curve will be centered around that stock price with a certain bandwidth. Okay, this is the assumption behind the model. Why am I telling you this? Because this is basically the reference. You see the prices that you see now on these calls and these puts. You know, at the end of the day, it's a free market, meaning it's the offer and demand that makes the price, okay? But what we have talked about, you know, who actually plays in the market? You know, institutions, banks, all of these actors. Well, the thing is, all of financial actors basically agree on using Black-Scholes-Merton as a model, okay? And so people who participate in the market will do their own pricing, or actually will see what Black-Scholes give as pricing. And that's actually the prices that you end up seeing in real life. Why? Because the participants in the markets all use this model, basically. And so this is how we can simulate and we can project and we can know that a certain option today costs this much and can rise or get down to a specific value. This pricing and the way of why people would put a bid and an ask that would be very close to what the theoretical model put, is that all of the participants use that model, basically. Does that make sense? It's really important to understand the fundamental of how prices operate. Okay.
Yes, this is important.
Okay, good. Now we've seen the fundamentals, the basic. Okay. Now when we composed this modeling, this pricing model, Black-Scholes, there was some derivatives of it. The derivatives meaning that it's the same calculation, the same model, but now we're actually looking at some metrics that will help us evaluate the option price. These metrics are the gammas, are the Greeks, Thomas. The Greeks are really outputs of this pricing model, where Black-Scholes model that we discussed basically give out the price of an option that should be today. Okay, and then you can also get these derivatives, and these are metrics that tell you about how your option price will behave versus other factors. The first factor is the stock price. Obviously, you would want to know, okay, if the stock price moves this amount, what will be the impact on my option price? Okay, so you're looking at the sensitivity of your option price versus the stock price. This is what we call delta. This is the definition of it, meaning it's really the sensitivity of your position price. What does it mean? It really means that if the stock price increases by $1, your position will increase by delta at the end of the day. Delta goes between -1 and +1, and so for calls it will be positive. For negative, for puts it will be negative. You understand why? Because puts, if the stock price goes up, puts will lose in value, so you need the delta to be negative. So that's the original definition. Let's try to keep it in mind. This is what I mean. Gamma is a better version, or a more sophisticated version of delta. Basically, it's in mathematical terms what they say, what we call the second derivative, meaning not the direct effect of the stock price on the delta itself, but actually on the position price, but the effect of the stock price on the delta. Delta will change when your stock price will change, and that itself will make for different delta. In other words, let me give you a metaphor so it makes more sense. By the way, what's your background, Thomas? Are you, I don't know, in engineering or in marketing or things like that?
A computer science.
Okay, so you can relate to these terms. Going forward, more and more things will relate. A good way to think about delta and gamma, it's really to see them as the speed and acceleration, basically. Delta is the speed, meaning that it's the speed with which your option price will change when the stock price will change. Gamma is the acceleration. Acceleration, what is by definition acceleration, is the change of speed, meaning that when a car accelerates, it's not necessarily that the speed it's going faster. It really means that from the starting point of starting the acceleration and the end point of ending the acceleration, first level you would be at a certain speed, and at the end you will arrive at a higher speed, right? Meaning that as the stock price moves, your position is more and more sensitive, for example. And here you can think of the exponential effect, for example, right? Where this is something that highly accelerates as the stock price moves, versus something that is linear, that would grow linearly. Something exponential, you would see this high explosion and high acceleration. So what we say high gamma, basically. Okay. Keep this in mind. This will be important when we go forward. Now let's look at the other two. Also, they are again outputs, and so by definition, sensitivity, basically metrics. Theta is the sensitivity to time. Okay, it really means that for every day that goes by, the effect of time on your option is this much. This is very important because options, this is a characteristic of options being different from stocks, where if you hold the stock, you can hold it indefinitely, as long as the company exists. An option, by definition, has an expiration date. And so after this expiration, this option would be worthless, whatever happens. If an option expires on Friday, the next Monday, it's not worth anything. And so the time effect on option is very important. It's meaning that time, if you are long, again, if you buy the option, time will eat out at your position. Okay, and it depends different levels. Some options are more or less subject to that. Okay, that's Theta. Now, well, the last one is Vega. So very important for us in earnings. We'll come back to this. This is really the change, the sensitivity, but now to implied volatility. Okay. Maybe let's take a second here to speak about implied volatility as a concept. Okay. So implied volatility is really an intriguing aspect of option trading, if you like. So it's the column you see to the far right. Okay. On the right. Okay. So for every option, call, put, or whatever it is, you have that the strike, the expiration, etc. There is another parameter that's sort of like an elephant in the room. That's called implied volatility. Okay. So let's try to understand the concept of implied volatility. Again, I will give you the original definition, or now that we've spoken about Black-Scholes, etc., what is the origin story of implied volatility, but more importantly, how to interpret it today and what it means for us. Okay. So remember that Black-Scholes model, right? Where this is the agreed model of pricing of options. Follow me, Thomas? All good? Okay. So implied volatility is another parameter that plays with that is a factor for every option. And it's really, you can understand it as sort of an extra parameter that we add in our model to, it really should, you should think of it. I'm not actually sure I should give you the original definition. It might confuse you. Really think of it as a metric or as a number that's reflecting the unusual offer and demand that's happening on that position, that contract. Okay, let me read. In other words, every option, okay, every option, every call for every stock, doesn't matter its strike and expiration. It will have a specific IV. Okay, let's say that specific IV. IV, Thomas, is something to always analyze in a global scheme. Okay, so IV at a certain point does not tell you anything. You can only compare it to the past IV for really that specific position. Okay, the fact that here, I see an IV of 58 for the 162 call, for example, that 58 itself doesn't tell me much. I need to know how it was yesterday, a week before, a month before. So really keep in mind, IV is something that you compare with itself. Okay, what does it mean? I'm not sure I want to go into the original definition. I'm thinking it can actually confuse. Really think of it as, it really means the unusual difference, the IV when it goes up compared to its usual level. Again, we always compare it to its past self. If it goes up, it means there is unusual offer and demand, basically. Okay. If it goes down, it means that same unusual offer and demand, but on a lower level. Okay, meaning it's lower than expected. So you hear on social media, and you hear a lot that people, for example, say, "Oh, very juicy premiums because of this very high IV." Because IV, through Vega, remember the fourth Greek that we looked at, option prices are dependent on IV. And there's this Vega Greek that is directly the sensitivity. And so when IV goes up, the option price goes up too. Okay. And so sometimes your option price can go up, not because the stock price moved. Nothing happened in the market, not because time or nothing at all. Just because IV of that contract got higher. Does that make sense?
Yes.
And so when you see IV, basically this pattern in IV getting higher, it really is making the options more expensive. So more expensive to buy. And again, keep in mind, more expensive compared to their usual levels. Okay. I think it's a good picture to see IV like that as this extra parameter, and so it's very important again to compare it, but for that specific contract and as a global metric, not punctual, basically.